Hello everyone. I will cover chapter 1 in this lecture. This chapter is about the investment environment, and these are the topics that we will cover in this chapter. So we start with some basic definitions. So what is an investment? An investment is an asset where we place our funds, and in return we expect to get some income at regular intervals, and we expect the money allocated to the investment to increase in value. So two types of returns. Next is portfolio. Portfolio means a collection of different investments. So we are investing in different assets in expectation of earning money in future. Return means the consequences of investment. It can be income from the investment, regular payments, or it could be due to the increase in value. The cash that we have invested, it increases in value, and that is another source of return. We start with some of the attributes of investment, and then we look at the structure of the investment process. So we look at some of the important concepts related to investment. First is security. Securities means these are investments issued by firms, governments, or other organizations, and they represent a financial claim on the issuer. The issuer in this case is the firm, government, or any other entity. Liquidity means the ability to buy and sell quickly. So we can trade the investment quickly. That means the investment is liquid. Then we look at property. Property means real assets. So it could be land, building, or any other permanent establishment. It could also mean some tangible items such as precious metals or precious works of art like painting or sculpture. Now, investment can be direct or indirect. Direct means the individual or the entity who owns the funds, they directly allocate funds to different securities or property. So they have a direct claim on ownership. Indirect investment means the individual or the entity who owns the fund, they transfer the funds to a professional investment manager. The investment manager then allocates funds to different securities and has a claim on the issuer on behalf of the owner of funds. So this is an information. So in different countries, what is the level of stock ownership in households? So we'll look at the concept of stock shortly. Then we look at different types of securities. The first is debt, where the investor or the owner of funds lends money to the issuer. The issuer will pay regular payments and will repay the invested funds at a later date. An example is bond issued by a company or a government entity. Equity means the owner of funds allocates money to the issuer, and as a result, the owner of funds becomes a shareholder or owner of the issuer. So a company issues equity, an investor buys the equity, and in turn, they become the shareholder or owner of that company. Derivatives are neither debt or equity. They derive their value from an underlying asset. The underlying asset could be debt or equity or anything else. So we will look at derivative instruments in more detail subsequently. Investments can also be classified based on the risk. Risk means the uncertainty in the return or the uncertainty in income from the investment. Low risk means the returns from the investment is more predictable and generally on the lower side. High risk means the returns from the investment is not predictable. It can fluctuate to higher values or to lower values, and on average, the returns are higher. And diversification means that we invest in different kinds of investment or different kinds of assets at the same time. Investments can also be classified based on their maturity or their life. Short term means the investment is of 1 year or less, and long term means if the maturity or the life of the investment is more than 1 year. Domestic investment means the securities are issued by domestic companies. Foreign investment means the securities are issued by foreign companies. Now we look at the structure of the investment process. So there is owner of capital who supplies funds, and there are entities who require capital who are known as the demanders of fund. In general, households spend less than what they earn. So income is more than expenses and they have some residual funds left. So they become net supplier of funds. The government at times spends more than what it has collected from revenues. So it needs additional funds. Similarly, businesses need additional funds to run their operations on a continuing basis. So government entities and companies are net demanders of funds. How do the suppliers and demanders of funds come together? So they can come together through intermediaries. One is financial institutions. So these are banks, mutual funds, and insurance companies. So they accept funds from the suppliers and they provide it to the demanders, either in the form of loans or in the form of investment in issued securities. The other intermediary is financial markets. So here the suppliers and demands come together and they buy and sell financial assets. And through that, they exchange funds. The financial markets have intermediaries to facilitate this financial transaction who are called brokers and dealers. So this is a diagram or a flow chart of how the suppliers and demanders interact. They can either interact directly and exchange funds, or they can do through intermediaries like financial institutions and the financial markets. So what are the different types of investors? Those who supply funds. So one is individual investors. So these are individuals who have surplus funds and they manage those funds by investing in different assets and try to achieve returns. Institutional investors are professionals who manage the money of other individuals or other entities. So they could be banks, life insurance companies, mutual funds, and so on. So they accept funds and then they deploy that fund through loans and investments and try to earn returns for entities who have provided the funds. So what are the different types of investments? We are revisiting the concepts that we have covered earlier in more details now. So first is short-term investment. Short-term investment, as the name suggests, is of maturity 1 year or less. So it generally has little risk and it also is highly liquid. So it can easily be traded among the buyers and sellers. Then we have common stock. So a company issues stock, investors buy this stock and they become shareholders or owners of the company. And the return that they achieve is through capital gains. That is the share price increases, so the invested money increases. They also receive money through dividends. That is, the company pays a portion of their earned profits back to shareholders. Then we have fixed income securities. So in this case, a company or a government will issue bonds and they promise to pay interest at regular intervals and repay the borrowed amount at a future date. It can also be convertible securities. So this is a debt instrument which at a later point is converted into stock. So a bond holder or a debt holder becomes a shareholder in future. Then we have preferred stock. So this is a special class of shareholders who are promised a fixed dividend at regular intervals. So even though it's a shareholder, they are promised regular incomes just like a fixed income security. The next is mutual funds. So mutual fund means it's a portfolio of stock, bond, or other assets, and the money is collected from different investors. So there is a professional manager or a professional management company who will pool cash from different sources and then invest in a portfolio of stock, bond, and other assets. So money market mutual funds are mutual funds which invest solely in short-term investment, that is, ones with maturity less than 1 year. Exchange traded funds are similar to mutual funds, except that they are traded like common stock on exchanges. So they also invest in a multiple stock or multiple bonds, and they help the investors to earn return. And investors can buy and sell ownership of ETFs on stock market or on stock exchanges. Hedge funds also pool money from different investors. They have a higher limit or a higher minimum investment, and they are subject to less regulation than mutual funds. The next type of investment is derivatives. So derivatives derive their value from some underlying asset. It could be a stock, it could be a bond, or it could be other assets like commodity. So one is options. So in this case, an investor has the ability to buy or sell the underlying asset at a predetermined price and at a future date. Futures means it is a legally binding contract. So the seller will have to make delivery of the asset and the buyer will have to buy the asset at a specific date and at a specific price. The difference between futures and options is if a person buys an option, the person may or may not exercise their right to buy the asset or sell the asset at future. But if it is a futures contract, then both the buyer and seller have to undertake the transaction of buying or selling the underlying asset at a future date. There are other kinds of investments also, like tax advantage investment. So in this case, if we invest money in certain instrument, so it gives us some tax advantage. The returns are tax-free. For example, municipal bonds. So this is a kind of debt instrument. So if we invest in this instrument, we will get some tax benefit on the returns or on the capital invested. Different kinds of investments are there. So then we have real estate. So it could be ownership of residential homes or a plot of land. And there is scope of rental income as well as capital gains, that is appreciation in value of the real estate. And finally, we have tangibles. So tangibles are like precious metals or precious works of art like painting and sculpture, which we can invest. They are valuable assets and they can also appreciate in value in future, which helps us to earn return. So this is a snapshot of the different types of investment that we have discussed so far and examples of different categories of investment. So that's all in this lecture. I will continue with the rest of the chapter in the next lecture. Thank you.